And good evening. This is the Eye of the Storm podcast for the S&P 500 and the NASDAQ 100. And also tonight I'll be covering the 30-year bond, the 10-year note, and the 5-year note as we update the larger picture, as so much has been going on in our marketplace that we owe it to update that larger picture so that we can get an idea of what we're heading into year end and what 2023, at least the first half, will likely end up looking like. Okay, again, I want to begin here with the bond market. So a lot has been happening with interest rates, and there's a lot of discussion and a lot of narrative being spun around that the fact the Fed's going to pivot and everything's going to look great. And so I don't want to have misinterpretations about essentially what's happening. Again, the equity markets are putting in a corrective counter-trend rally. That's what we've been involved with since the lows that we had most recently in both the NASDAQ and the S&P, and I believe those would have been in October. So we have been involved in that counter-trend rally in the equity markets. Now, here in the bond markets, that they reached a low pretty much in October, and I'm using the monthly chart, and I can show that here on the 30-year bond, let's go over some of the givens. Again, going back to August of 1981, which is the last time that the inflation rate ran at such a high percentage, similar to today. So at that basis, we've had strong inflation. And back then, the interest rate for the 30-year bond reached a high at 14.49%. That was the yield. Is the yield on the 30-year bond. On April the 20th of 2020, the 30-year bond reached a yield low at 1.17%. So they had a 30-year yield high at 14.49, a low at 1.17%. And as of December the 1st, the 30-year bond yield was at 3.64%. And the magic level, from what I can understand, to where big positions are going to start to get changed up. And if indeed we're finally going to be told or convinced, or everyone's going to be on board that the United States, we are going to move into a recession. If we're not already in it, it's going to get heavier in 2023. And inflation will continue to rise, and so will interest rates in an attempt to put a stop to that. Now, the caveat in all of this, again, which may force it higher under a more, what we might consider a positive note for our local economies and for our economies and for the country, would be the fact that the infrastructure package we know passed, that's law. That money gets to start to be doled out next year. So more people will be finding jobs, good paying jobs with benefits, courtesy of reconstructing our infrastructure, putting people back to work on many different sectors as we build up within our country. So what does that tell us? That tells us that we are likely going to see a large shift in positions, because as I don't believe that I've actually spoken about it, but there are going to be times during any corrective phase where, the basic thing when bonds topped and they started to go down, it was get out of bonds, because the yields are going to go, and therefore the price of the bond will sink. And as we saw, that's exactly what happened. The 30-year bond, as I just pointed out, dropped in 5 waves down. So therefore, we have an ABC corrective phase. This is my monthly maximum, okay? A 3-month weekly counter trend rally to put in. And being that I'm out on a monthly chart and we're sitting here where that would be what I would assume could be the minimum. I mean, considering that we've already come up 13 points, right? And that could be just very small first leg. And this would be a minimum retracement. We're looking at 145, 146 in the bonds that they come back. What's that going to present to investors, to market watchers, to everybody, that they can get that yield? If right now the yield is at 3.64, what's it going to look like at 145? How low will it have gotten? So we need to factor this in terms of how the market's going to receive it, because it's going to be a little different. So let me keep going on in our bond market so that I can show what we're confronting in terms of it's time for a correction in the bonds. So here in the 10-year note, so the 10-year Treasury yield, in September of 1981, the yield reached a high. The high yield was 15.30%. Now, in May of 2020, the low on the yield, the high in the bond price, was 0.69%, sub 1%. And they traded there for a long time. March 21st of 2022, the yield stood at 2.48%. On December the 1st, they were at 3.53%. Bear in mind, 3.50 is a level that triggers a lot of position changes. Now, I'm going to go down to that 5-year note. And what we have, same deal. First of all, on an LA basis, I can count 5 waves down. Here again, August the 17th in 1981, the 5-year Treasury reached a high. The yield reached a high at 16.31. It would have been a bond price low. And unfortunately, I only go back to 2008, I believe. Yeah. So it's as much data as I can get. Let me see if I got my maximum. No, probably got one more. And it's actually going to go back to 2008, same deal. All right, so let's look at this. In 1981, 16.31%. In August of this year, of 2020, excuse me, the 5-year note reached a low of reached a yield low, bond price high at 0.23. Now, because of the nature of the 5-year note, it's much more sensitive to larger moves in interest rates. So again, short end of the curve versus the long end of the curve. On December the 1st of 2022, we were at 3.68. Again, we're in that neighborhood of 3.5, 3.5%. So it really works itself around the 10-year note. So now, what can we start to look for? If it's done 5 waves down, we're going to do 3 waves up. And because I have seen longer term charts, which you can get from several services, and they're available, you can just pull it up online and you can go and look at them, that I don't know what degree, but I know that in most cases, even in the bond, I don't go beyond a cycle degree, just because of the nature of what it's representing and what that can happen. So we don't have where we're looking at something over a grand supercycle degree or a supercycle degree. So cycle is about as high as I will go on treasuries and precious metals and et cetera, a lot of commodities. So if we're considering that this yield low, price high would have been, let's say, up there in the cycle degrees, we've got a larger correction in ABC. And since I can count 5 down, I'm going to count it as an A of something. So the other thing to remember under Elliott, that 5 waves down, no matter the degree, in a corrective fashion, is never the complete move. But even if it's just 5 waves up sitting there all by itself, it's never the complete move. So we need to get 3 waves in one direction and then an additional 5. Then I can start to either call it an ABC or 1, 2, 3. So, but all by itself, never a complete move. So I will be looking for 3 waves up and then an additional 5 waves down. Now, I can take this down to the weekly, and we've got a little bit different picture. We can see that 3A2, whatever this 5 down, 3 up, the minimum would be 38.2%, that it retraces 38.2% of the decline. But a 50 to a 62% for a B wave, absolutely. It fits. It would work pretty cleanly. And then what we get after that is an additional 5 waves down. So whatever's going on with inflation, whatever's going on with the Fed, it's going to get to a point where they will relax rates. We will see the bonds come back, whether or not they physically lower the rate. If they stop raising every meeting and hold a rate at one level, the bonds will trade more freely up and down, and with a little bit different purpose. So while they maybe relax and don't do that, then we're going to see that movement based on the pivot that they're now being called on. I mean, the pivot, a lot of people say it was like they're pivoting from being hawkish to dovish, and that's not necessarily so. That is pivoting, of course, but pivoting also is they lower the amount that they've been hiking. We've had a consistent 3 quarters, 75 basis points for three of the last hikes, maybe even 4. So the premise was that they pretty much were saying they were going to raise it 75 basis points for the December meeting. So the pivot would be if they only come in at 0.50, a 50 basis point hike. Then it's a little bit of relaxing. They pivoted from what they were scheduled to do. Doesn't mean that they're going away. Doesn't mean that inflation is receding. Doesn't mean anything other than we're giving you all a break and we're just going to slow down that rate and see if what that might do. What it's going to do is force these bond prices higher. That part I'm going to tell you. But it's still a correction. So when we look, we can now notate where these are, and we can start to try to understand, well, what level would the rate get to at these levels? If all the way down here was that, I'm going to go back out so I can see it. On the first, which would have been up here, but down here, possibly closer to 4%, 3.75, I'm not sure what that low represents. I'd have to get a yield chart to tell you. So, but it is a low, and we're looking for the bounce. Same deal. Now, understand, and I'll get over more into that when I get over to the equity markets, there were certain numbers, the CPI number being one, and then last week when we had, I can't remember what the number was, but we had an economic figure come out last Wednesday, and boom, we had a very serious pop. And then we had unemployment numbers on Friday, or the employment situation number on Friday, and that caused a big drop. So one didn't balance out against the other in terms of that we are really fighting inflation and the Fed's going to pivot. But the number was based on Jerome Powell's, not the GDP, but it was based really on more on Jerome Powell's statement that the Fed could consider. They could consider slowing the pace of hikes. So instead of 75 basis points, 250 basis points, we could consider that. And that was enough to trigger what I'm calling a risk-off trade. So in other words, there comes that time when that traders or hedge fund managers, portfolio managers, and just large traders that are carrying multiple positions across the board in when you're managing a lot of 401k money, you've got to put it to where the market's really going to be. And so much is in treasury, so much is in equity, et cetera, et cetera. And that shifts around, particularly if the rates are looking like they're going to bottom and the rates are going to start to go up. You don't necessarily want to be in bonds at that level. So you sell your bonds. And as it comes down, there's going to be a point where you move back into the bonds because there's going to be a shift. There's going to be a shift of money out of the equity markets and in to the bond market. If we saw a shift out, moving money out, it had to go somewhere, and it went into stocks. It went into other things. But then inflation came tripping along, which is going to hurt corporate earnings, which is going to hurt our pocketbooks, which is going to hurt how we live. So the analysis and what the larger banks are beginning to say, have been saying actually, is that the United States is going to be dropping into a recession, a stronger recession, and how the US markets are not prepared. So that message that we got from Deutsche Bank, from somebody that is respected for their analysis and for what their work, was basically saying, what does that suggest? Well, we got another taste of it on Jerome Powell's talk. The risk off would be that the yield could go lower than 3.5. If that was the target, we're there. Take your risk off. And that's basically what we're seeing. And it translates over into buying the equity markets. It's kind of a knee jerk. Because, inflation's better, this is going to happen, interest rates aren't going to go up, we're going to see this, we're going to see that, et cetera, et cetera. That's why I continue to call it in the equity markets. We are in a corrective counter trend move because eventually one catches up with the other. If we're going to start to see that shift out of equities back into bonds, notice on Friday, as that market dropped like a stone, the bond market went up strong. Shifting out of one, putting it into the other. If that continues, we're risk off and putting it into another market. It's coming likely from equities. Let me finish here by going down to the 5-year note, which also had some pretty incredible moves. In August of 1981, the 5-year note was at 16.31. That was the high yield. In August of 2020, the yield low was 0.23%. And on December of this year, the yield was 3.68. Now, what can we say? Same deal. 5 waves down, we're going to get 3 waves up. So we've watched now across all the bond markets, same story. Oops, that one didn't work. Let's try that again. All right. 5 waves down, 3 waves up. We've got it going across the board. All right, now let's go over. Let's take a look to the S&P. Again, this is the daily, this is the monthly max, and you can't basically even see anything. So let's go, but you can see the power of cheap money. From there to there is when we saw interest rates drop, and then be held low for long periods of time as this money was lent out at interest rates that were unbelievable, right? If you could borrow 5-year money from the government at 0.23%, okay. So, or from anybody, you're ridiculous, but people were buying those bonds and taking that interest rate. But let me bring this down. And let's start with the daily. Now, what I have done is this is an alternate count, right? The count as it stands right now. This A is over here. The B, the primary B is still there. We get the 5 down, and that's intermediate wave 1. If this is still an intermediate wave 2, what possibly, and I'll get into that in a moment. See, what I believe that we can do is we'll look at both. In any case, what we're looking at is we had a very nice rally. So, but let me give you this alternate view. And again, a lot of it's going to be if we're running the risk that while all of this shift is happening, somehow equities skyrocket. The money comes pouring back into the equity market as it's being shifted and shipped over to the bond market. I don't know. But if that doesn't happen, then it's going to be the preferred count. But I wanted to show this, so I've relabeled just by dropping this, and also just to make it easy. So I've taken out the minor degree in here, or what was the minor degree, and now would be the minute degree. I just dropped it. So when I revert it back, this will be moved up to intermediate wave C, primary wave A, intermediate wave C, primary wave B, intermediate wave 1, primary A goes over here, primary B, intermediate wave 1. But right now, I've moved it. And I'm moving it to just demonstrate we've had 2 large rallies off of economic data as these risk positions get switched around. A lot of it had to do with the expiration on December the 2nd. I think we have more on December the 9th, and then we have the Fed on December the 14th. So we could continue to rally, and I wanted to cover it. And even as this, it would allow for a much larger move. We can keep ABC, X, ABC, and if we put an A up there, we still could get a B wave down, but then an additional rally. If indeed this was the case, and let me open this up so you can see this. So if this is the case, right? ABC, X, AB, this was 5. We saw it. We looked at it pretty cleanly. And I can still move this and put this in as a C and leave it. If it is, it possibly could be the intermediate wave 2. And that would suggest that we just start to go. But here we have something that is presenting a little bit different picture. Because what we got going on is this turns into 3 waves down. And then this comes all the way almost back up to, not to the top of the wave, but it reached above from where it started. Yes, it dropped lower into the belt, but it's like trying to figure out what that could be. So if, again, wave 2 is over, and again, I want to go back out to that daily chart, ABC, and that could be, so I could drop that labeling. Instead of being minor, it would be minute C, and it would be minor wave A. This all could be a part of minor wave B, excuse me, not minor, minute wave B, and then we get another drop, or we get another C wave up, right? If this is minute C for A of B of B, C of B for another B. Again, I know it's a ton of ABCs. And then we flip and turn and we run up to put that C wave in and then cap it with an intermediate wave 2. So we still run the potential. Let me go back out to the 4, because now I want to put some fibs in there, because we got to go back now and realize if what we're doing. So if I'm going to put, first of all, that would be the preferred. Now, if I'm going to put it in for this count, and I would have put here A, B, C, put a C there and call it intermediate wave A. And now we're doing an intermediate wave B, and these are all within the primary degree, right? So we do an intermediate wave B down, an intermediate C wave up to finish a primary B wave, then you're for sure looking at these levels. And I'll tell you why. I got to go out to the daily again. So what we would then be looking at is we're correcting that A. Well, it started up here. And all I want to do, I'm not going to put any extensions in yet. I'm only going to put in retracements, because what I'm retracing is this. Now, 382, we've reached it. 50%, 4155. 618, which could be a B wave. You're looking at 4309, and it still does not cross over 4327. So I can run both counts up to that level and still either consider it an intermediate wave 2 or a primary B wave. So I want to show you how, again, these two can run side by side. But what we're looking at is just a much larger wave 2. And a lot of people think that, well, that it doesn't necessarily fit. Well, here I'm going to show you, yeah, it can. It can fit. And it would work. So again, ABC A, ABC B, C wave up, get it up into here, get it up into here. That completes either a primary B wave or an intermediate degree wave 2. And then we fall, and fall. So primarily, I'm also showing that I believe, yes, I still think a lot goes out until December the 14th. That's a major, we'll find out. But if they truly do only raise the rate by 50 basis points, the market's going to jump all over that. They will demand their end of year rally. And that's kind of exactly what I believe. If you're trying to move out positions in preparation for a recession, I need to sell stocks. Well, yeah, I'll sell them at a higher level for sure. Better for me, better for my portfolio, et cetera, et cetera. So either way, buyers might be feeding right into the market turning severely and moving lower, whether it is in a primary B wave or an intermediate third wave. So where it goes up, either in a primary B wave or an intermediate wave 2. So what comes next would be a primary C wave down or an intermediate third wave down. Both promising to be pretty devastating. Both promising to be pretty severe and pretty hard. So I'm just switching labeling around because we need to consider and look at the possibility that either we're done at that 41, whatever it was, 41, 13, 14, where was that? 41.10 high on the first, or that's only going to cap wave A of the second, ABC. And I drop these to my notes and it works. And then we get a B wave. Is that rejection? And there has to be some response to the unemployment being more reflected. Either that, or I got to tell you, I can do the ABC and I can put the C up there, and that's going to be the second minor A. And then we get this ABC. That's going to be the minor B. And this is 1, 2. And now we're just going to go 3, 4, 5 and end up here, or even higher up to that next level. And it still will be a minor, or excuse me, an intermediate wave 2. But I'm covering us because if we have that possibility where they'll carry it higher, then we're looking at this primary B wave bringing us up to 44.22. Now that covers the break, should it occur. It doesn't change that longer term picture where, folks, we are going to go down, but it's going to be a matter of when, not a matter of if, but a matter of when. And so what might produce this move is not a sudden tone change where, oh, we're bullish and inflation's taken care of and interest rates are going to drop, drop, drop. It's like, no, there's just a big switch going on. There's a big sector move from treasuries from treasury / bonds, from equity. So from equity market, from stocks over to bonds, from a lot of markets over into gold. Check out what gold does during recessions. Gold definitely is I believe, going to rally. It caught a little bit of a downdraft on Friday. But the reality is that once that nonsense about, well, this is happening, so you sell gold, this happened, so you buy gold. The day before, gold was up $55. A little pullback, sure, why not? So I feel that what we need to just pay attention to is this little short-term count, and that we do have more room to the upside, and we do have that possibility, and it exists. But the underlying factor is not going to be because we're recovering, and everything in the downside is over. That's the misnomer I do not want to be putting out there. I do not think the downside is over, and I don't care whether I have to label this as a primary B wave or an intermediate wave 2. There is a large decline waiting to happen, and there's plenty of reason for it to occur. Whether it takes 2 weeks before it begins, or whether it takes the rest of the month of December before it begins in January, I do think it's going to happen. So I will update the near-term picture, but this is just talking about the big picture. So I'm not going to go below this hourly chart at the moment. So we're just waiting for this all to be complete, and whether it's going to be an intermediate wave 2 or a primary B wave. Either count suggests that we have additional upside. That's more important. And that picture I will update tomorrow on more of like what we can expect for Monday and next week. Now, over in the NASDAQ as well, I'm going to go out to my daily. Same deal, just switching it around. Same deal, except here it's a little bit different. Here, if I come down to my 4-hour chart, you can see that I'm already labeling it because it came in a little bit different. I moved the X back over to there. I know I move it around a lot, but it's just because, not that I need to make this work, but I need to cover. It's like this was 5 waves up, 5 waves for wave A. Oh, 3 waves down. Well, that's a nice for a B wave. Now I'm looking for a C wave up. So again, let's put in what we can consider that is the level. Let me see. I got to pull this back out to my daily so I can take a peek. Yes, that's the number I want to get. So I'm just putting in retracements, and that's the low. So now I'm going to go back down to my 4-hour chart. Let's go, and I'll open this up. So what are we looking at? Gee Louise, we're right back to that 12,500 again. Now, if this indeed, I'm going to open this up even a little bit more. I can put another layer in there. If indeed this is the A and now we got the B as I've marked it, let's take a peek. Now I can throw in some extensions. There. There to there. Now take it back down to that hourly. If I'm looking for a C wave up, 12,159 is 0.618. Wave C would be equal to 0.618 of wave A. It clears that high. It clears that high. That would be it. It's not an uncommon stopping point. That would be first. Then we have 12,273, 12,418, which is where wave C would be equal to wave A. Nice. But we have others that on a entire intermediate wave 2 basis, it would reach 0.618% on a retracement level at 12,500. But if it wants to keep going, it can, to where wave C would be 1.618 times the length of wave A at 12,836. So we have numbers that can carry us up to 12,800, 12,700, etc. We have 12,500, 578, 678, 780. So we've got the numbers that could take us up there. The only fib levels does not mean that's what's going to happen. It means that's potential. And that would come in the form of a C wave. So first level I'm going to be looking for is that 618, which is like way down here. Also, where a trend line comes in. So we have levels. Now, what happens if it just really gives up the ghost from here and it starts to drop like a stone? Well, I'm going to get rid of some of this so that we can see it. Right now, we've got the 50s. They're all turned and they're all looking pretty sweet. But they see they've got one little flat, but here they are. See, they're rising. The 200 starting to rise. Even with that severest drop, it caught the 4 and the 8 and the 20, drifting right quick. But here we got them all turning, and they're crossing back above the 50s. So we've got some momentum going where it may have just switched and gone back. And then once they're all above this 50, the rise is on again. So, and if you remember what I said on Thursday, that going into Friday, it wouldn't surprise me. I even said it, I said it in my trade room. After this drop, I said, it wouldn't surprise me to see the market take it all back, rally all the way back up. And they got pretty dang close. In the S&P, they succeeded. In the NASDAQ, they got close. So what we can say is that the NASDAQ continues to be the weaker link, the weaker index right now. So the problem still sits within the tech stocks. Now, and again, we've got another expiration coming next Friday, and then that Fed meeting on the 14th. Can we get up to 12,500 between now or tomorrow and the 14th? Yeah, we certainly can. And again, we've got economic figures that'll be due next week. I'll be reviewing all of that. On the big picture, we have to allow it. Now, if I go back out, and let's just go back out to that daily, and we're looking at this, then what I also need to do and include is looking here to get this one in. So that one, and now I'm going to put in, retrace, come on. I hate it when it does that. Retracements in, again, from this high down to this low. And now I'm going to bring it back down to my daily. And I want to get rid of these. But you can see we have a 50% retracement. Oh yeah, I do want to leave them up there for a second. Here's the number that I don't want it to cross for an intermediate wave 2, 13,740. 741. It can get 13,626 and only be 50% on a primary B level, right? Because that would be retracing the entire decline thus far. So primary B level, yep, it could get up there. If I switch the count around and we're still in a primary B, yep, 13,626. But it can keep going. 618 is 14,367. Is that possible for the NASDAQ? Sure. We've seen the NASDAQ make these massive moves against the grain, so to speak. So yeah, it can do it. But that would be, so whether it's going to be a primary B wave or an intermediate wave 2, we still have a nasty decline coming. But we need to get through all of this. We need to let the market do what it needs to do. We need to let the shift happen. If it's going to be risk on, risk off, whatever is going on, Give it that room because it's going to happen whether you like it or whether we don't like it. It's still going to happen. So what are we looking at for next week? Actually, what we're looking at for the couple of weeks here until the Fed, and then likely until the end of the month, is what I'm laying out. The possibility, we can have a primary B wave rally, or we could have a continuing rally, and within the confines of the second ABC, within an intermediate degree wave 2. So the second ABC on a minor degree to complete an intermediate degree wave 2. Either way, the way the market's positioning, I'm thinking that we go up to 12,500. And I know I've been talking about that and talking about it, and it keeps failing, and it looks like it's going to go there, and then it fails. Maybe this time it actually would do it. I think either way, we should have additional upside before all is said and done. I'm going to leave this edition of the Eye of the Storm just by recapping again. Reviewed 30-year bond, 10-year note, 5-year note, to suggest that they've all done 5 waves down off of their bond high, so bond price high, yield low. They've done 5 waves down, or in the case of the yield, 5 waves up. And now we are likely doing I'm going to call a B wave inside that, to off of the yield lows, bond price highs, down to the recent price lows. We're just, and so those yield very near term high. So the yields are going to come down a little bit. The bond prices are going to go up. And we went over those levels, right? So what those yields had the possibility of getting back, getting down to, or getting up to. So I think we got a lot of more interesting things coming, and we're going to see what actually takes place. So I'm going to end it right there. And the next Elliott Wave update will be tomorrow, December the 4th. Thank you for listening today. Have a great trading week.